Good afternoon, everybody. My name is Mark LeGrand. I head up the new business development at Quigley Transportation. From a sales standpoint today, very brief. Check out our website. It'll be in the slide deck that each of you will receive for joining us today. Our goal is to help organizations that have issues and concerns that they're either aware of, or sometimes they don't even have awareness to compliance concerns and so forth. So check that out at your convenience. Our approach is straightforward. Simply, we have a conversation about what issues and concerns serious enough to do something about. We ask you some questions, you ask us some questions, and of course the economics of everything have to make sense. So that's it from that extent. I just want to welcome everybody. Thank you for taking time out of your busy schedules to join us today. We're really excited. We've got an expert speaker that's joining us that Brett will introduce in a second. It's one of the hottest topics in the transportation industry the last 6 to 18 months. So we're honored to have Brett join us today. So with that, I'll hand it over to Brett Quigley and do a quick overview and introduction, and we'll jump right in.
Okay, thanks, Mark. Well, let me go ahead and stop my video here. And just want to welcome everyone and thank you for taking the time out of your busy schedules. I know everybody's time is valuable, and I appreciate you taking the time to attend today's webinar. So, Mark, it's hard to believe that this is actually our 6th webinar. And since it's been 6 months since we started our webinar series, and over this time, we've seen registrations continue to increase on a monthly basis. And we look forward to continuing to provide these as an educational tool for carriers that attend. And even those that can't attend, we obviously provide this deck free of charge to them that register. So it's certainly a way for us to give back and hopefully answer some questions. We also, I'd be remiss if we didn't say that we welcome suggestions on future webinar topics. One thing that, we have our thoughts as far as what's important. We also want to hear from the attendees as far as what are things that you would like us to present on as well. So please send us your emails on that. So this month, we're going to be focusing on the industry's skyrocketing insurance costs and the steps that you can take to control the increases in insurance premiums for your company. But first, I want to take an opportunity to share a little bit of background on myself and Quigley Transportation Management Solutions. So as far as myself goes, having over 40 years of experience managing 3 of the nation's 100 largest private fleets, earlier last year, I embarked on a mission and formed Quigley Transportation Management Solutions, where I handpicked a team of consultants that I've worked with for years that demonstrated an excellent base of knowledge, work ethic, and a commitment to success. Together, we're leveraging our decades of experience to assist smaller companies reduce their transportation costs while improving their compliance and reducing their risks. As the slide says, we are in the pain relief business. And by this, I mean that we help our clients relieve pain that they have relative to DOT compliance and fleet management. That could be with the administration of the various programs. Could be financial pain, having to employ additional people or pay fines. Also losing revenue as a result of a compromised safety rating, which we're seeing several of our clients suffer through that today, where they're losing about 40% of their revenue after receiving a conditional safety rating. We also not only offer consulting services, but also a wide range of other fleet and DOT compliance related services. So drug and alcohol testing is a good example. So companies are required to do it. We offer that as a service in addition to many other services. So I'm also proud to share that we have gained many new clients as a result of the information that they've gained via these webinars. The general feedback that we've received on the content has been very positive. with compliments regarding our level of expertise and the non-aggressive approach we take. Just this week, one client that we're assisting in obtaining an upgrade to their safety rating after they received a conditional rating as a result of a DOT audit, shared that if he had only partnered with Quigley before the audit, it would have been much less expensive and relieved a ton of concerns that he had regarding DOT compliance. Okay, in their most recent annual survey, the American Transportation Research Institute, or ATRI, identified insurance cost and availability as the fifth most critical issue facing the transportation industry this year. Fleets have experienced rate increases of nearly 20% over the last 5 years, driven in part by the nuclear jury awards being issued against shippers and carriers. Recognizing that this issue affects every carrier, we felt compelled to invite an expert in the industry or the insurance industry to speak on this topic and answer any questions you may have. So besides the fact that he has a great first name, and I share that, I have the pleasure of welcoming our guest presenter, Executive Vice President with McGriff Insurance, Brett McGinnis. First, a little bit on McGriff, and then I'll let Brett expand on this. But McGriff Insurance is a full-service insurance broker providing risk management and insurance to clients across the U.S. I personally had the opportunity to work with McGriff as an insurance broker for the companies I've worked with. They provided outstanding service. So with that, I will turn it over to the presentation over to Brett McGinnis, and we'll go from there. So Brett.
Thank you, Brett, and I hope everybody can hear me. Does that sound good?
Sound good.
Excellent. Appreciate this opportunity, everyone, and appreciate the opportunity, and specifically Brett and Mark, to get together and kind of share our market transportation update. So what we're seeing in the industry. A little bit of background on the transportation practice that I am a part of at McGriff. We're a national transportation broker. We have offices throughout the country. Our transportation practice is located in Portland, Oregon, where we oversee, manage, place, service some of the largest motor carriers in North America, all household names, as well as small affinity business too. So for the smaller motor carriers that operate as well. Names like Heartland Express, Southeastern Freight Line, JB Hunt, TFI, CFI, and several others, Amazon and several others, we participate in handling their risk needs, as we do in the 3PL marketplace. So as Brett had mentioned earlier, the importance of DOT compliance and safety ratings, I'm going to touch on that a little bit as well, because it is critical in the 3PL marketplace and how they assign freight to different motor carriers. So happy to be here, and we'll go ahead and move into the next slide. So the overall market overview is we're coming, finally we're coming out of COVID. So, or at least we should be coming out of COVID, right? So, but we keep hearing the news try to penetrate new variants and strains that are going to put a little bit of stress still on the marketplace in the future. However, as we've seen in the truckload and refrigerated, both dry and refrigerated space, we've seen rates come up to an all-time high that we haven't seen before for service. No difference than what we're seeing in the local distribution models as well. The challenges still exist for the freight, the flatbed and specialized industry as they're trying to catch up and ramp up to satisfy the needs of the constant growth and building across the country. However, it's still a little bit of a wait for them. As Brett mentioned earlier, we're seeing a lot of challenges beyond the pandemic, especially in the large losses, nuclear verdicts, which we'll touch on a little bit as well, no different than the social unrest, and then natural catastrophes and how that rolls into transportation overall at the same time. We'll move to the next slide. So the commercial transportation insurance market, and I'll try to just summarize this as well. So since the most important thing here is since 2010, the market has not seen less than 100% combined ratio in transportation as it pertains to insurance underwriting needs. So 100% ratio, what does that look like? Well, when you aggregate the cost of claims as well as underwriting expense, claims handling expense, uh, insurance agent or broker expense, and the commissions that they're compensated with as well, bring those together, the underwriting market is not seeing anything better than 100% for their dollars. So every dollar that goes in from premium is going right back out the door. And oftentimes it's the ratios we're seeing is more along the lines of anywhere between 104 to, in some cases, 110, 112%, depending upon the underwriter and the type of business that they're putting together. As that's happened over time, we've seen a contraction in the underwriting marketplace. And in doing so, whereas in the past, probably 10 years ago, there was a good 20, 25 transportation specific markets that were underwriting in the business, that number's really dropped down to below 10 now. Some are trying to get back into the space because they've seen the amount of rate that they're able to get, but it's still, they're not able to truly sustain their platform in underwriting because the losses are just outpacing the industry premium that's being collected. And so as you can see there on the recent results, the commercial automobile down below in the graph, the blue is the loss ratio. And while some people might say, well, an 80% loss ratio is not bad, the company's still, aren't they making 20%? That's just on the pure loss experience. When you combine the expense ratio over the top of that, and then a very small amount of the dividend ratio that you could barely see on over the expense ratio, that in comparison to the net written premium, which is the line that's going across in gray, it's easy to see that they're still having challenges. And so some markets more so than others. And that's why we see some underwriters enter the marketplace and then they turn around and they might pop back out in about 3 years. Or you'll see a market such as Progressive, where they jump in, they're super aggressive, they're writing a lot of insurance in the small truck space, but then 6 months later, they pull the reins back because the loss experience is just outpacing the premium. So lots of challenges that are happening in the marketplace. We'll move to the next slide. The primary auto liability is what's really kind of the big challenge right now. And then excess is even worse. So, but in the challenge for the primary auto liability, so the standard limit that we see out there being utilized is $1 million limit that's being provided by the underwriters. That's become, even though FMCSA standard is requirement of $750,000 for a common or contract carrier, the true industry benchmark is the $1 million limit because it's driven by the needs of the shipper and the 3PL. And we're finding that is really having a tough time. And as I mentioned in the previous slide, we see increases in this space anywhere between 8 to 15% on average through the next year. And we've seen it settle a little bit, but we still are seeing the average come in with an underwriter saying that they want at least a 10% rate increase. We try to negotiate that down and make it less impactful to our customers and clients, no different than hopefully your agents are doing for you, but it's still a strain. And it's really driven by what they're seeing in your information results that they can pull online. And so safety, DOT compliance, your safety rating is critically important as it pertains to how the underwriter is viewing your business, because the technology that's being deployed now is much deeper into what they can see rather than just looking at IFTA reports, loss runs, and an overview of your overall operations. The excess liability market is the real challenge, and we continue to see rate increases on that are anywhere between 20 to 30% on average. There's not many carriers that want to participate in the primary limits over your original $1 million that's being provided on your auto liability. And the challenge in being so is the nuclear verdicts that are coming into play, the large losses, has put a strain on the buffer layers that we're seeing from other underwriters who have left the marketplace. AIG left the marketplace probably about 5 years ago. It could have been 6, and that changed everything when their underwriting arm, Lexington, left that excess marketplace for the small to middle market motor carriers. And once that happened, rates started to climb quickly. As each underwriter has come into the space, equal number of underwriters have also exited. And so as we see on the large fleet business, pretty much the primary player on the what would be considered the primary level of first 10 million in the tower of excess is pretty much Chubb. And Chubb has been that player for the past couple of years now. And even then, it's putting a strain on them. So trying to build out towers now on excess liability because of these average nuclear verdicts that are exceeding 5, 10, $20 million is also putting that strain back into the marketplace as well, as far as underwriters wanting to step in and participate. So we can possibly see a little bit of a loosening in this space, but we're just not sure yet because we hear that there's different underwriters that want to participate. We just don't know how long they'll actually be able to do so. Let's move into the next one. I also want to, if there are any questions that pop up, feel free to ask those, and I'm happy to answer them as they come in as well. But I will continue to move forward. So nuclear verdicts, what's a nuclear verdict? And we're all kind of wondering, where is that going to lead? So we found in one particular, the Top Auto Express, they were found liable for an accident in Florida involving 18 vehicles, 8 hospitalizations, and the jury via a Zoom, a verdict or what have you, they awarded $411 million in this claim. We just saw a recent claim that happened here over the past weekend that I believe was either in Tennessee or Alabama. Similarly, 17 vehicles involved. The first report was there were 10 fatalities in that, and there were 3 trucking companies associated to the claim. Average auto liability that's being afforded is probably going to be around $50,000 to $100,000 in limits for a private passenger vehicle in those accidents if they are involved and deemed to be at fault. However, it's the trucking industry that's going to bear the brunt of paying out anything that's going to exceed that. And so the challenge in doing so is this is what is driving those high excess auto liability rates, and even on the primary side, because it's very quick to settle out a $1 million loss. But now what we have is we've got litigators for claimants that are utilizing financing that's coming from the private equity field, and that sector is being able to pump in the type of funds that's needed to get a ruling that's going to be much more significant than what we've seen ever in the past. And so in essence, the insurance companies are battling against something that they're just not truly prepared for. And so as this continues, it's going to constantly give more and more pressure into the marketplace. And that's why we keep seeing the challenges that we do. We'll go ahead and move on to the next one. So another problem with the industry, and I'm sorry, guys, we are in challenging times. There's no doubt about it. It's been building up for quite a while. The driver shortage. The driver shortage continues to be a problem, and we think it will ultimately be that way for several years to come. So not only did COVID hurt, but the challenge is trying to bring in a new truck driver. Their viewpoint is the working conditions are poor, the compensation is not good compared to the hours on the seat. And so we're seeing that CDL issuances were down more than $100,000 in the first half of 2020, and that 10% of the 46,000 drivers with drug and alcohol violations returning to duty, the headwinds remain real, but not easily addressed. And so the challenge that we have there is that once a driver is exiting the marketplace, they're not coming back. And so bringing a new driver in is becoming more and more difficult. And underwriters are wanting a driver that's at least the age of, typically they want 23 years of age and 2 years of driving experience. It's becoming harder and harder to pick up, and it's going to continue to be that way for the foreseeable future. So it's become easy, unfortunately, to not work in our country recently than it is, to work. So until those changes start to happen as well, I think we're going to be into this for pretty much the long haul, and we're going to have a tough time trying to see any type of recovery into the future. So now it's really about how do we retain the drivers that we currently have rather than losing them to somebody else, and what type of opportunities are there to build and expand upon, whether it's a driver recruitment program, whether it is a level of ability to bring in a driver, we see a lot in the sign-on bonus coming back into play. We hadn't seen that for about 10 years. Now it's becoming really prevalent again. However, what we're seeing is the best results are coming from driver referral, and rather than just paying out a driver bonus. The driver bonus programs that we've seen in the past have a constant churn. The driver will continue to look for that next bonus that they can get after they've put in the time that was needed to pick up the bonus that they just received. So doing it from a driver recruitment standpoint, we think we've experienced with our clients that those drivers are able to attract a like kind and attract to a culture that best fits your operation. And so we see that those are actually having the best overall results. Next slide.
Hey, Brett, can I interject real quick?
Yeah.
We got two questions relative to coverage amounts. So if I could throw those in now. The first one is, any thoughts on your side about the bill that was reintroduced to increase insurance limits? So the minimums, like you talked about, 750, et cetera. Any thoughts on that?
Yes, it's a great question. I think that there is going to be a time when that is going to increase. Is it going to be now? I'm not sure about that. I think the challenge is that it will contract the marketplace even more. You'll see a large fallout. Similarly than what happened in the freight brokerage 3PL space, when the freight broker surety or bond increased from a $10,000 to a $75,000 limit as a requirement. And so we saw a lot of contraction that happened then. I'm not sure it's something that's going to take place in the next year or two. It is going to take place at some point. I personally see that number going up to a $2 million primary limit. And hopefully the underwriters will be prepared for it when that happens. But it is going to come with a cost.
Gotcha. Thank you. And then the other one, you mentioned AIG/Lexington exiting. How long, do you have a crystal ball, so to speak? Do you expect the excess rate increases to continue?
So another very good question. It's interesting. So literally 2 weeks ago, we saw a first sign of softening in the excess market. So that happened with 3 accounts in particular in our office. All of them more regional long haul. So West Coast, I-5 corridor, Washington down to Southern California, and then into the 11 Western states. So we did see that their renewal actually, on those 3 cases, actually came down 15% from expiring. So we see that there is some opportunity. It really depends on the risk. and how prepared they are as far as their overall exposures are concerned and what their record looks like over the past 5 years. Losses, driver retention, safety rating, their cab report, and the like. So we're seeing it soften a little bit. I'm not going to say that, hey, we're in a soft market, but I see a little bit of light at the end of the tunnel, which is, I think, great news for everyone. Now, on the large scale, I will say real quickly, on the large fleets that are, self-insuring the first $5 to $10 million of any loss, their excess towers are still very, very firm. They're very hard. The rates continue to climb pretty quickly for them because of the type of verdicts, the type of claims that they're getting associated with as having a much deeper pocket, so to speak, or knowing that there is a much higher limit that is available. There is a stronger push by the claimant attorneys to go after those companies with a different level of vigor than someone who, let's say, is operating 5, 10, 25, 50 units.
Gotcha. And then one last one, when we're talking coverage and cost, this question, and if there's any other questions, feel free to shoot them in to us, please. Is it a good idea for me to consider lowering my limit to combat my increasing costs?
So we hear that a lot, and that's a pretty common question. We always like to try to, explain it as it's always best to obtain as much limit as you can reasonably afford without it becoming a strain on your company's overall operating budget and investment in safety. There's a couple different parallels that are happening here. Do I buy more limit, but then in order to buy that limit, I have to save over here or discount other parts of operations on the other side? Ultimately, your best overall defense is how you operate as a company. And so if you have, if you truly believe in what you've put together in the best of class, in risk engineering, in safety internally, in culture and the like, it's going to make things a lot easier for you to feel a little more confident in being defendable without having to have such a high limit. Other things that people are looking at as well is they're just looking at the overall, what is the value of the company? And some trucking companies we're seeing are starting to carry a much higher value or EBITDA that they have experienced in comparison to their past. So there's a need to possibly protect that as well. It's a tough conversation, but I think it's one that you go through with your insurance broker. You ask them questions about it. I think it's always good to get additional options for higher limits on your renewals, just to see what it looks like, and give you that opportunity to be able to make an educated decision based off of those variables I just mentioned.
Great, thank you.
Mm-hmm. So big things here is your operational type, and a lot of things that we're trying to figure out here is not only a geographic scope and different ways that you guys can address the driver shortage issue, but some of the recommended areas of driver support. These things are also very helpful for your underwriters as well as you're working through maybe an upcoming renewal or as you're operating as a company. And so the type of technology that you're utilizing in delivering more communication. So the enhancements, including task management systems, template discussion plans, mobile apps that facilitate communication between management and drivers, are all positives, and underwriters see those as positives as well. There are great driver training programs for a driver that, for instance, gets into an accident and you want to try to do some type of training for them and bring them into an opportunity to better themselves as a driver. and also be able to display, in the event you're in a future loss, the steps that you take as an organization, and how you guys address that, rather than just pat them on the back and say, hey, tough luck, and that's the way it goes, and keep on heading down the road. Those instances will ultimately create problems for you in a defendability case. So information sharing, so transparency between the managers and drivers, and making sure everybody's on the same page. It helps out with culture, educational opportunities. So same thing that I had just mentioned previously, whether you're utilizing an online tool that might take 5 or 10 minutes to access for your driver, once a month or something like that, or as needed, all are great tools.
Hey, Brett, if I could interject and ask a question. What are your thoughts on in-cab cameras?
I'm sorry, Brett, say that again.
So what are your thoughts on in-cab cameras?
Oh, well, so everybody says, oh, the drivers don't want them and so on. I think there's a couple, and there's a couple ways to look at it, Brett. There are two types of drivers. There's a legacy driver, and then you have an emerging driver. And the legacy driver is someone who's over the age of 50, possibly even over the age of 60, and they've been in the industry long enough that they're set in their ways, and there's nothing wrong with that. They really don't want a camera that's looking at them. They might accept that they'll be more acceptable to a camera that's looking out a window, but they really don't want to have a camera watching them. The emerging driver is a little bit different. They are used to a shared world, a shared economy, information. They know that their cell phone is watching them constantly, and if it's not, watching them, it's listening to them at the same time. So for those drivers, I think that there's a little better comfort level in utilizing a camera tool. Underwriters love it. They think it's great, but they want to also make sure that it goes beyond just, hey, we put a camera in the cab, and so if we have a claim that we turn in, we're going to have some footage for you. They also want to know that it's being managed, and it's no different than it gets back to the whole defendability process for the motor carrier as well. Is what are you doing with that information? Are you utilizing that information to help the driver be a better driver? Are you utilizing that information to better defend yourself from fault? Oftentimes we see that is a huge help. And I think the cameras, as they evolve, are going to start becoming an OEM product in the tractors anyway. So it's going to end up becoming more of a streamlined type product, and we're going to start seeing them in the private passenger autos as well. No different than a backup camera. We already have a camera that faces forward. I know I have it in my car. If I'm nudging out into traffic too much, I will pick up a warning, and it's not just from a sensor. The camera will come onto my dashboard as well, and on the screen, and let me know also. So personally, big fan. I think they are very, very helpful tools, and I think they really help out the underwriters in determining, whether they not only want to underwrite the risk, but how aggressive they get in doing so.
Thanks, I appreciate that. And
Mhm.
I've used cameras in the last 2 fleets that I've managed, and I agree with you. I think there's a lot of benefit to it. A lot of it comes down on how you introduce the cameras to the driving force. And if you throw them in and it's perceived as a big brother tool that it's only going to be used for disciplinary purposes, it's not going to be well received. But if it's introduced as a way to help defend the driver, as well as help train the driver, I found that it's greatly more better received that way than the other way.
Totally agree, Brett. And to further to that is, it's also, this is really, ultimately, it's not just from an insurance standpoint or anything else. This really does help the driver. We see drivers now for gross negligence that that can do prison time because they were deemed to be grossly negligent in how they operated their vehicle and the type of accident that was that happened. And that's pretty important too. And so when it comes back to, as you just shared, and I agree 100%, if you share with them, I'm here to protect you. I'm not here to spy on you. I'm here to help you and to protect you. I think it's going to be taken a lot better than being heavy-handed for sure.
Okay, thank you.
Yeah. So workers' compensation, we continue to see, challenges from work comp, but their average combined ratio now is at 91% from 2015 to 19. So we think that's actually, that's pretty good. Underwriters are very happy with that. We are seeing a big softening in the work comp marketplace and premiums. Obviously it's all driven, it's a little more directly driven as far as how mod factors work to your particular loss experience. But it is, it's kind of a little bit of a fresh, breath of fresh air, especially in the state of California. We're seeing rates that we haven't seen in quite some time. And so it's been very positive for them. In other areas, you might have states like in Oregon, which utilizes a state accident fund, where they're providing dividends back to their policy holders. They've performed very well at the same time, as is like in the state of Washington, where it is all state managed through labor and industries. There are retro programs that you can join there as well. That can get you an opportunity to recover some of your premiums. So we're very happy with what's happening. Still, we have some uncertainty with COVID and how that's going to impact work comp. We saw that actually impact a couple of our paratransit clients back when in March, April, May of 20, when COVID was really just picking up steam. So it'll be interesting to see how those things work themselves out as well, as far as coverage in the future from that exposure. Next slide. So the reason why I have property on here is, and because a lot of people say, well, this really has nothing to do with, it doesn't have anything to do with trucking. And ultimately, property losses are kind of they kind of set the benchmark or the tone in the insurance industry for reinsurers and the like. That participate in the property coverage space, as well as that participate in transportation. So even though you have, let's say, a Great West Casualty, which is a very well-known, phenomenal, best-in-class insurance company, been in it a long time, they're ultimately owned by Old Republic, and Old Republic also participates in the property market as a company on a direct level and through reinsurance. So, when you look at losses in 2020 in the market space of property, you're looking at $83 billion in losses worldwide. So it's a big number. It gets a lot of attention. And as you can see in the graphs, you can see how the spikes happen, and there's a trend to them. So we're kind of predicting that 21 will likely see a spike in losses. We have an earlier hurricane season than we've had in the past, or tornado season than we've had in the past. So those things will obviously impact this domestically. And then the renewal pricing trends, they're starting to tick up a little bit as well. We don't see it a whole lot for like small trucking companies, mid-sized trucking companies that are, they have a terminal and an office and a shop, that type of property risk. So we think that has pretty well stabilized, but these things do come back and impact the casualty side of the business for the likes of trucking liability and excess liability. So next slide, please. So just kind of conclude some of the things, that we like to do with our clients. some of the things that I think is very proactive for everybody on this call to be doing themselves with their insurance broker is make sure you're talking to them, not just when you get up to 90 days before renewal. Have a dialogue that's continuous as you guys come into different changes, different exposures, different things that you're looking maybe to get into a particular lane that you haven't done in the past. How is that perceived by an underwriter? What is their take on it? How can this impact you for your renewal? A lot of folks will go out and they'll start chasing after that business, and they'll start chasing after that mile per, that rate per mile, get themselves out of what is considered their true comfort spot. And then you have an underwriter that's coming through at renewal, and they're trying to actually go through a rate increase with you, and you're scratching your head kind of wondering, well, wait, why? I don't understand. And part of that could be that lane has a higher level or a propensity from an actuarial standpoint to loss, even though you haven't seen one yet. So those types of things are really important. Brett mentioned earlier as well, and I wanted to touch on safety rating and the importance of that. So some of the clients that we handle are some of the largest 3PLs in the industry, Global Trans Worldwide, now that they've aggregated and come together. It's one of the reasons why I'm in Phoenix actually to meet with Global Trans, so who is a client. Transforce Worldwide, XPO, so many of these, Radiant Global Logistics, and so many folks that are clients in the 3PL space. When it comes to truckload freight, they are very, very acute in understanding how those exposures come back to them, because their rates have been going up over the past few years as it pertains to truckload freight, for contingent auto liabilities, cargo legal liabilities, contingent cargo, errors and omissions, and the like. Because they're being pulled into losses no different than the motor carrier that they're scheduling for service. So as with that, they are taking a much deeper dive into your safety rating. How is that safety rating looked over not just the current state, but what does it look like over the past 6, 12, 24 months? And what are its trends looking like going forward for the next 6 months? Because they're able to look at what those trends can come out to as well. So the importance of that safety rating is critical to any operation for a motor carrier. And it doesn't matter if you're a one truck carrier or you got a fleet of 10,000, it's still important. And they are very, very tight at looking at that information. So, and they utilize different tools in doing so, whether it's Safer Watch or whether it's CAB and the like. It's critical information, and it's all live to them. So make sure you're also monitoring that same information as well, because others are looking at it at the same time and determining whether they want to give you freight, or whether you want to be on the top of their list or maybe on page 2. So keep paying attention to that. Work with Brett, work with Mark on those items in particular, because that really does make a difference in your operations.
Yeah, Brett, I was just going to expand on that a little bit. So we monitor those websites as well, and we're seeing approximately 4 to 5 carriers a day pop up with conditional safety ratings. Some days it's more, some days it's less, but on the average, I'd say it's 4 to 5 a day. The thing to keep in mind, if once they get a conditional safety rating, it's not an overnight process to get that upgraded. The DOT is fairly accommodating when a carrier gets an unsat rating and jumping on and trying to get them upgraded to a conditional rating, but not so much when you get a conditional rating. And what you submit in to the FMCSA for the upgrade request is very specific on what they're looking for. So I've seen a lot of our clients come to us after they submitted a request in, and it's missing information. It's not to the extent that DOT is looking for. So then we help them get that upgrade accomplished. But like I said, it's not an overnight process. It'll take, DOT has 45 days to respond to your upgrade request. So you're looking at 45 to 60 days minimum in most cases to get that conditional safety rating upgraded. And like I said, some of our clients have experienced 40% revenue loss while they had a conditional safety rating. So the best thing obviously is not to put yourself in that position where you're faced with going through an audit to begin with. But certainly if you have to go through one, even as an entry level or new entrant, to be faced with a conditional safety rating, have your ducks in a row. We can, if you have questions, we can certainly help you with that and provide programs to assist to ensure your compliance. So, all right,
Yeah,
Mark, do you have any other questions? I'm sorry, Brett, do you have comments?
well, yeah, just one thing on that, Brett, because and I can't agree more with it. It takes a lot of work to be considered a top performing carrier for a shipper or a 3PL freight broker or the like. But all it takes is that rating to end up becoming quickly forgotten, because it will restrict them from providing freight to you, because they don't want anything to do with it as well. Because it calls into their practice that, oh, you gave this load, and this is how attorneys do this. Oh, you gave this load to Brett McGinnis Trucking, and he's conditionally rated. Why would you ever give him freight? I could have the best trucking company on earth, but for whatever reason, I am conditionally rated because of different different circumstances. But they don't want to have to answer that, and so that's number one. Number two, most underwriters will not underwrite you if you're conditionally rated. And the ones that do take great advantage of that insured in doing so. And so if you are, it's the first thing that the underwriter will look up. Well, these guys are conditionally rated. Sorry, management call. We can't do it. And I'm talking about some very good underwriters. I mean, from Great West to Northland to Protective to AIG to Century and the like. Now, you might be able to get a renewal because you've already been with them for a long time and you have that relationship that is there. But trying to get a competitive market to come in and look at your business and try to get some level of cost savings, that just doesn't happen. And if it does, it is extremely rare.
Right. So, Brett, I got one last question that came in, so I'm going to make it last call. If anybody else has a question, feel free to shoot it in right now. Otherwise, we're about to wrap up. If you don't get a question in and something else pops into your mind, feel free to email us at the conclusion of the webinar, and we will get back to you from there. As far as this question, I need some help because I have no idea what this means. It's what impact, if any, will the California House Bill AB5 have on the rest of the country?
So the California House Bill AB5 pertains to the independent contractor status and the ABC method of determining whether you are crossing the line with an independent contractor and bringing them into an employee status rather than truly staying independent. A lot of motor carriers are actually pulling away from the state of California and not operating any independent contractors in their fleet going in and out of that state because of House Bill AB5. What California wants to do is they want to make all independent contractors in trucking, they want to make them employees because of the controls that the motor carrier has over them in the current state. So from dispatching, safety, oversight and training and so on, the state is saying, hey, wait a minute, these really aren't independent contractors. These are actual employees. Now, there's a reason for that as well, and leave it to California. They see an opportunity for employment tax. So And if any state needs revenue, it's California. However, with this, you're also starting to see New York and New Jersey get on board with similar House bills. I suspect we will probably see the same without question in Washington and Oregon, because they do whatever California does. So that will eventually spread across the country and convert that status from independent contractors to an actual employee. Or the other option would be that they are a contracted carrier that has the right to refuse freight, and almost to the point where you then become a freight broker, and you have a carrier authority. And then for those that you're going to provide freight to on a contract carrier basis, that's going to be done on through a freight brokerage entity. So interesting waters to navigate over the next couple of years. But AB 5 in the state of California is very, very real.
Great. Thank you.
Yep.
No other questions came in, so I'm going to hand it off to Brett Quigley for the wrap up.
All right. Well, thanks, Mark. Thanks, Brett. Appreciate the insightful comments today. Again, I just want to thank everyone for their time and participation in today's webinar. Recognizing that July is a peak vacation time for everyone, please join us for our next monthly webinar, which we'll host in August. So we're going to take a hiatus in July. So until then, please be safe and let us know if we can be of any assistance with your transportation needs. Thank you.
Thank you.
And thank you.